afternoon, everyone. Welcome to the webinar on inflation and risk management. We have a record amount of attendees. I know what's on everyone's mind, whether you're an investment partner at Origin now, or you're just trying to manage your own portfolio, or you're interested in real estate. So I'm going to be joined today. My name is David Scherer. I'm co-CEO of Origin Investments. I'm going to be joined by Marc Turner, who's our Managing Director of Investment Management. Marc has been leading our team for well over 6 years now, and he's overseen our transition from value-add investing to multifamily development exclusively. A very successful transition. We have over 10,000 units that we either own, operate, or are in development currently. Just a couple of things before I get started. On the presentation, we really want to make this interactive. So number one, we're going to limit our presentation to about 40 minutes. And then Marc and I are going to answer, we hope, every question. Thank you for those of you that submitted questions prior. I believe we have 700 attendees on this webinar, and we had probably 5 or 6 dozen questions we sorted and culled them down, but we'll be trying to answer all of those. In addition, if you have questions live, just go to the Q&A feature, and I will try to answer those live with Marc at the end. So with that, I'm going to get started, and we'll start the slide presentation. Just a little bit about Origin. I think a lot of the folks on the call are existing partners. In fact, we have 2,500 individual and investment partners now. 50, actually 52 at this point. Registered investment advisor partners. So if you're an investment advisor or an investment advisory firm, we have 52 partners, and essentially they invest on behalf of their clients into Origin funds. What I'm most proud of is we're a top decile fund manager, and typically when you look at footnotes, they're not that important. But in this case, they're actually really important. And the reason is that designation is for all of the work we've done since 2014. And so it actually encompasses 4 different funds. And I'm really proud of our consistency. You'll also see in the fine print, we were actually named number 11 out of 262 global real estate managers. So that puts us about the top 3%. We just say top decile because it sounds easier than we're top 3%. And so I'm really proud of that. We have 40 people at Origin who wake up in the morning and think about multifamily. We're spread out across the country, Marc's team, our acquisition teams. And so we have a lot of local knowledge, but we're centralized here in Chicago. Lastly, I'll touch on our returns. I guess that's how you get in the top decile. 2.1 average equity multiple, 24% average gross IRR. Again, that's for all of our work, and we've been, we have 8 funds at this point, so there's a lot of deals to make a statistically significant set. The last thing I'll talk about is the personal investment. We're really proud that our founding principals and now our growing team of professionals have invested $65 million of their personal capital into our funds. And that's significant. We've raised about $1 billion in equity at this point. And so 6.5% has been our own. And it really matters. It's not different, it's better. It's better that your investment manager is aligned with you. And we're extraordinarily aligned. Next slide, please. So let's jump right in. The state of the market, this slide really captures what's been happening in terms of sentiment and now policy. When you look at January 2021, this is tracking the CPI and the inflation rate. You started to see it percolate in March of 2021. And then into the summer, the question became, okay, now we have inflation, but is it transitory? And you heard that a lot in 2021. It's transitory, is it, isn't it? I can tell you that here at Origin, Marc and I and Dave and our co-CEO Michael and Tom Briney and others, we really didn't see it being transitory. First of all, define transitory. What does that mean? Is transitory 3 months, 6 months, 12 months? To me, it's three to 6 months. If it's beyond that, that's not transitory. And so in my view, and in our team's view overall, we didn't really see that as transitory. So we'll start to talk about some of the things we did, given that that was our opinion. But from a policy standpoint, the Federal Reserve did view it as transitory, really up until about November, December of last year. And that's why you see this, the volatility in the markets is because the Fed didn't talk down the markets, talk down the fact that they were going to change their policy, stop adding to their balance sheet, in fact, start shrinking their balance sheet, and then obviously raising rates. They didn't start doing that in Q2, Q3 of last year. They actually were saying, we think it's transitory. We're going to stay the course. And that actually probably led to asset inflation that was over and beyond what should have been there. Money, when it's printed at that level, you saw their balance sheet, triple, get almost to $10 trillion balance sheet, which is over 3x what the Great Recession balance sheet was. When you have that much capital placed into the economy, now remember, the difference between the Great Recession and COVID is the Great Recession was a lender-caused recession. You had lenders that lent too much. A lot of the loans were made at bad valuations, and they were going bad. And so what's important is when the Fed was intervening in the Great Recession, there was no multiplier on money because the lenders themselves were so weak that they couldn't increase. You could increase them one money supply, but you couldn't increase them two and them three. That's the multiplier. A bank takes in money, but they can lend 5, 6, 8x of that. Well, in COVID, they weren't weak. This was an exogenous shock. And so when the Fed was increasing its balance sheet, essentially by buying assets and placing capital into the economy, it could be multiplied. And so it was a very different animal that we're in right now. So as we saw when the Fed reversed course, with a pretty innocuous statement from the Fed Chairman Powell, these are minutes in between meetings that really are only scrutinized by bond traders, but he snuck in the comment, we're not going to continue to, we're going to start a new monetary policy. And initially it was just, we're not going to keep adding to the balance sheet. And then it became, we're going to raise rates. And that's what we've been dealing with since early January. Now, let me back up for a second. Inflation is real right now. The question is it transitory or isn't it? I think if you were going to define transitory as 3 to 6 months, I think it will outlast that. So I don't believe it's transitory even now. But I do think that a lot of things the Fed is doing, and they're doing it just by speaking to it, is they're taking a lot of the multiplier effect, at least out of assets. And so when you're thinking about the NASDAQ, for example, the NASDAQ has a lot of companies that are high growth companies, but they don't have earnings. And so a lot of the companies with no earnings but high valuations, they've already corrected 30 to 40%, in some cases more. And that's largely driven by the Fed and the fact that the risk-free rate and the expectation of the risk-free rate being higher is putting pressure on discount rates, which hurts valuations. So let's talk about supply, pandemic-related supply constraints. That's been real too, and it's also been a little bit of a perfect storm. So yes, there's been supply constraints. A lot of it is labor-driven. Some of it is logistics-driven, but 20% of our workforce is in flux. They're either leaving their jobs to a new industry or they're moving. to different regions. So we've never seen that type of labor force movement. So that's part of it. But then you have little mini issues as well. Like, for example, when the Canadian truckers blocked the bridge from Canada to the US, that was fairly recent. That was last month. There was a 10-day period where no goods came from the US or back to Canada. And that's COVID related. I believe the truckers were mainly concerned about masks and vaccinations and how they're going to be treated when they bring their goods into various regions. And so there's a confluence of events, but they're real supply issues right now. And so that's contributing to it. And the net is the Fed plans to tighten monetary policy. Chairman Powell came out yesterday and said the expectation now is a 25 basis point increase in March. That was actually lower. The market was believing it'd be 50 basis points. That's probably why the market rallied yesterday. But the market expects, between 5 and 7 increases this year. And where does that leave us? We're at essentially 0 right now at the target rate. It probably leaves us between 1.25 and 1.75 by the end of the year, which, by the way, is still an extraordinarily low borrowing rate. And we need to keep that in context. It feels high coming off 0, but that's a historically very low risk-free rate. And importantly, that's the front end of the curve. The back end of the curve is suggesting that it's going to slow the economy, tame inflation. And that's why the rates are so low. I mean, today, the 10-year note yield is 1.85. So if you really believed that inflation, meaning the market, if the market believed inflation was going to be 7.5%, why would you accept a negative 5.5% real return, right? The nominal rate minus inflation. It wouldn't, right? So the collective market believes that inflation will be tamed. I'm not saying they're right or wrong, but that is what is the widely held belief. Next slide, please. So how did multifamily do in a world where there was inflation? This is a really interesting slide, and both Marc and I will go into detail of why multifamily is such a great asset to own in an inflationary world. This tracks the red being the inflation, and you see it, essentially going from 1.5% all the way to where it is now, call it 7%. And then the blue is monthly rent growth, and the black is the multifamily returns. Remember, the multifamily returns is both rent growth, it's rent collected, but it's also the asset value itself. So it's the expected value of the asset that you own. And what you can see is both the blue and the black are greatly outperforming. So think about this for a second. In 2021, so started at very low inflation, 1.5%, 2%, but then it went to 5 by the summer and then into the 6 range, in the late fall, November period. And during that period, you have this massive spread. Let's pick the high point of inflation, 6 during 2021. You still had a 14% return relative to 6 in a real level. So the 20% return in the black, minus 6, 14% real return. And then in rent growth, you were at 15%, minus 6, you had 9%. Extraordinary, but also predictable. Why is it predictable? Well, CPI itself, one of the biggest inputs into CPI is the cost of housing, and it's measured by rents. And so as rents are going up, that's good for obviously a multifamily, an owner of a multifamily building. That's what we do. It's an input into CPI. It's a reason why CPI is going up, is that cost of housing component. And if you believe that there's going to be inflation, you also believe that the rate of rent growth will pick up and be sustained. And so that actually is the expected future cash flows of assets are discounted back. And if you're having enough growth, you actually wind up with higher valuations, which is actually the black, and that's what happened. Another way to think about this, and I think Marc is going to talk about this in more detail, but first of all, rent, paying your rent, it's not a nice to have, it's a need to have. You need somewhere to live. And so a lot of these discretionary items are cut back in an inflationary world, but not where you live. That's the last thing you cut. We saw it in COVID, and now we're seeing it in sort of the second effect of COVID, which is this inflationary environment we're in. And housing was resilient yet again. It was resilient when COVID hit, and there was all that uncertainty around that. And now it's actually quite resilient in the inflationary period that followed the teeth of the pandemic. Next slide, please. Why multifamily? This is a decision we made. Obviously now we have a very large portfolio, but we've been investing in real estate since 2007. And we made decisions very early on. One was we wanted to focus on multifamily. And then the second, and Marc will get to this, is about our geographic specificity, where we want to be, where we want our people to live, and where we want to acquire scale and assets. But why multifamily was quite easy. We're a data-driven firm. First and foremost, that's our DNA. If you look at multifamily over a very long period, 30-year period, tremendous data set, it's been the highest performing return in real estate over that period. And that's, again, we can get into why, but I'm going to focus now on the risk side. Interesting enough, in investing, you usually either get the highest return or the lowest risk. You don't get both. Here you actually get both. You're getting historically the high return, but you're also getting the lowest risk, and that's measured by standard deviation. And that's when you see in the blue in the graph, that's multifamily. About the same return as industrial, but in terms of standard deviation, much, much lower. What you're looking at, the numerator being returns, the denominator being standard deviation, yields your Sharpe ratio. Sharpe ratio is the measure of risk in any investment, and you're looking for it to be the highest it can be. Multifamily is by far the highest in real estate. And so that's why we chose it. And interesting enough, in the stress tests, which we also look at, the two stress tests of the last 15 years, they're very clear. One is the Great Recession, 08 to 11. The other is COVID. The thesis bore out perfectly. In both cases, the economy was very, very strained, and multifamily greatly outperformed. In this case, this latest iteration, industrial did equally well, because you saw this move to a virtualized economy, and you need industrial for that. You need last mile distribution, but multifamily did just as well. And in the Great Recession, multifamily did better. So that's why we're in the asset class, high returns, low risk. And we haven't seen any deviation from that. The last thing I would say is, in a world where technology is disrupting lots of the ways that we consume and behave, Office is the latest example of that. There's a new entrant into Office. It's called Microsoft Teams, Zoom, etc. That has permanently taken demand from Office. In the same way that Amazon and all the online retailers permanently took away a demand segment from retail, from brick and mortar retail. I don't think that's possible in multifamily. You can't virtually live somewhere, as much as the NFT world wants to tell you can. That's not possible. Next slide, please. This is really interesting. I'm going to focus on last year. So the 2021 period. Essentially, last year we had 700,000 units nationally that were absorbed, but there was only 360,000 units of new supply. That's why you saw record rent growth. And if you think about it conceptually, with so many people in flux, they're moving jobs, but they're also moving geographically where they live. There's a huge need for housing, and it's further imbalanced geographically. So Marc will talk about the regions we're in, but the regions that we focus are the regions the regions that people are moving to. And that was another sort of long-term investment decision we made that has proven to be the right decision. But in general, people from New York, Chicago, California, essentially the old Rust Belt as well, states, they're moving to lower cost states. They're moving to states with better weather. They're moving to states with more business-friendly practices. And what you wind up with is the Southeast, Texas, and Southwest. And so big picture, number one, there's more demand than supply for multifamily. That's why rents are going up. But I will tell you, it's even more exacerbated, this imbalance in the Smile states, which is the Southeast, Texas, and Southwest, because that's where all the people are moving. And that's where the demand's the greatest. Importantly, this isn't going to change. Millennials are getting married and forming households later. You have Gen Z behind them. And what's interesting is you also have the group that's sort of age 50 to 70, I'll call them the empty nesters, that still want a vibrant lifestyle. And we're seeing a lot of that group in the assets that we own. For example, Marc, our asset in Texas, in Dallas, Alto Highland Park, these are people in the 50, 70-year-old demographic. They've sold their multi-million-dollar homes and they're choosing to be renters. And they have plenty of disposable income, but that's a renter by choice. And that's really who we're targeting. And they're a big subset. It's not just millennials and Gen Z. It's actually also an older demographic that's staying healthier longer and is choosing to rent as they downsize. Next slide, please. It's my last slide, but this really is the crux of why Origin is focused so heavily in development. And I will make the argument that this is the best time for development that I've seen in my career. And it's interesting because I just wrote an article on this that was, I think, published last week, but everyone focuses on the input costs. And they should. It's real. Lumber is very volatile, and it's higher than it was a year ago. And so are your other costs. Labor is higher. We see that. And so it's natural to focus on that. But the other two inputs into the development model are rent growth, which is also record rent growth. And the expectation is that it's going to continue. But then the third is capitalization rates, which is the future multiple on stabilized EBITDA. And those have gone up remarkably because the expectation is that you're going to have rent growth and higher cash flows in the future. So two of the three important metrics in the development model are actually going your way. And you can see over this very short time horizon, we just chose Phoenix, but we could have chosen any of our target markets. This could be Nashville, it could be Austin, it could be Charlotte, it could be Denver, it could be Colorado Springs. Look at the margins from Q4 2020 to Q4 2021. They've absolutely exploded. Typically we've done a lot of development at Origin. We've actually developed for 4 of our funds already. So if you're in Origin Fund 2, Origin Fund 3, our Income Plus Fund, QOZ 1, we're now investing on behalf of QOZ 2 and Growth Fund 4. So there's 6 funds that have development in them. We're very experienced at it, and we've done quite well. Our returns have been above 25, 30% IRRs on average in our development stuff. But typically in our underwriting, we've underwritten to a 30 to 35% margin. And that was what we were targeting to our underwriting. And Marc will get into why we're very conservative. And you should look for managers who are conservative, and we'll explain how we look at the world. But in an apples to apples way that we view the world, the margins have gone up by 30 to 55%. I mean, that's an increase of 75% in the margin. It's almost double. And so what that's telling you is we're getting paid for risk, right? So we believe we're still underwriting conservatively, but what if we miss? What if there is $1 million overage? Well, maybe the margin goes from 55 to 48. That's fine. That's still well above what we've seen historically as a good opportunity set. So we'll get into the details of why, but the short answer is 2 of the 3 inputs into a model are radically going your way right now, and that's the capitalization rate and rent growth. I would find it's almost impossible to find a world where all 3 are going your way at the same time. And if it does, it's a moment in time, and it's probably a 4 to 6 month period that goes away. So with that, Marc, I think I'm going to turn it over to you. And I took too long, as always. So you have about 15 minutes. All right. Thanks.
Yeah. No, thank you, Dave. As you talked about earlier, for most of us, housing's our biggest expense. And when you're in an inflationary environment, that typically impacts renters harder than most homeowners. Homeowners typically fix their debt long term. Renters don't have that capability. But when it comes to multifamily investing, there's an inverse effect. And assuming you can control expenses, and you illustrated this on some of the earlier slides, and in controlling expenses, that would include the cost of debt, which we'll talk about shortly, your margins are going to expand as the revenue increases through higher rents. And that is in itself a hedge against inflation. And what's also unique about multifamily is that we don't have long-term leases. They're typically 12 months in duration. Industrial and office leases could range in duration from 5 to 7 to 10 years. You don't have the opportunity to mark the rents to market as inflationary pressures increase rent. In multifamily, you do, and that's certainly a better hedge against inflation. But how do we determine where rent growth will be the strongest and the most durable? And Dave, you touched on this, is 2 key things that we implement as part of our strategy. Is we approach our target market selection really started with in-depth knowledge of market fundamentals. And that's with boots on the ground of people who live in their markets, know where you want to specifically invest. You could pick a market, a large city where you want to invest in, but where specifically in that market is the path of growth? Where do people want to live? Where do they want to entertain themselves at restaurants and nightlife? Where is it convenient for them to get to places where they work? And so having that localized knowledge is really critical to identifying the places to invest with the most growth. We're looking obviously for places where employment and demographic trends point to future opportunities. So we're marrying that sort of local knowledge, expert knowledge, with a lot of data analytics. And to further our capabilities in identifying these growth opportunities, our in-house data scientists built what we're calling Origin Multilytics, which is a machine learning platform that applies really layers of building and neighborhood block by block specific data points directly into that proprietary model. And when you can marry all the number of data points that we look at that we believe are major indicators of where there will be rent growth, along with insights that we gather from having real estate specialists on the ground with relationships with local developers, we are able to better pinpoint where those highest potential opportunities are. And as you see in the map on this slide, we believe there's certain markets they're going to have the highest growth potential, but drilling down even further into those markets, where specifically into specific neighborhoods do we think the highest growth is going to be? Next slide, please. It's interesting. You probably have all seen the headlines of significant wage growth that has accompanied a lot of the cost increases that we've seen over the last 6 months to a year. And pay for finance, information professional employees rose 4.4% in January from a year earlier, which outpaced the even strong wage growth for all workers of 4%. But increasing rent levels may pose affordability constraints in some markets. So as we continue to see inflationary pressures that continues to put pressure on companies in a war for talent to increase wages, can that keep up with the cost of higher rents that we're seeing in our markets? And so affordability is a real key metric that we spend a lot of time thinking about. It's an important, one of the major inputs into our analytical models. And it's been the base, one of the key points of the basis for our selection of our markets. And we've selected those markets because of their lower rent affordability ratios relative to other markets. And that's illustrated here on the graph. The ratio, you think about it, it's just really your rent expense as a percentage of annual adjusted gross income. And it is one of the best indicators of the ability to raise future rents. So if you can raise future rents, that in turn will translate into higher investment value down the line and a greater ability to hedge against inflationary risk. Next slide, please. So as important as selecting the right markets and the right locations within those markets to identify the strongest rent growth, another important hedge against inflation is our underwriting tactics. And the volatile commodity prices, they're making projections difficult, obviously. But there are ways to mitigate the risk. And what we typically do, and it's sort of a key part of all of our underwriting, is we use a conservative pricing strategy. That pricing strategy looks at material costs, primarily lumber and steel, but there's other materials that go into the sort of the inputs that are needed to build any structure. And we allocate more money for such those events. In every deal that we approve and decide to invest capital in, we're applying a pretty healthy contingency because there are always uncertainties. You can do your best in terms of trying to remove the uncertainties from a project, but there will always be unforeseen events. So anytime we commence a construction project, we're building in a pretty healthy contingency. Let's say it's 5%, which is fairly typical, and suggest that's about $2.5 million. Well, beyond that, we will also assume another $1 million for rising construction costs. And then we'll see if the deal can withstand that volatility. So if you have a deal, a particular investment that can withstand $3.5 million in contingencies, and that'll cover your cost of capital and the profit, 35% or higher, as Dave noted on one of the earlier slides, that's a deal worth doing. So a lot of hedging against inflation risk is about how you underwrite and how you sensitize for things that you can't predict. We have no idea where interest rates are going to go. We don't know idea if the Fed's intended actions will quell inflation, but we can run sensitivities around that and scenario analysis around that. And we make our decisions based on sort of not what happens if everything goes right and everything calms down, but what happens if things don't, or what if they get worse, or what if the Fed makes steeper actions than everybody expects them to do in the near term. So when you think about the contingencies, it really has three possible outcomes. You could have a higher capital outlay, higher construction costs than what you're anticipating. That could eat up the entire contingency, but you're still going to have a profit margin of 35%. We could see relief in some of the material costs, labor costs before we complete the project, and we'll have savings from the initial underwriting, and that will add to returns. The expenditures can work out closely or completely aligned with our budget expectations without touching the contingency fund. And we would still have that $3.5 million contingency fall to the bottom line and win. So this is in essence creating insurance against downside risk, but there is upside potential if costs don't run more aggressively than what everyone's anticipating. An important investment metric that we find really useful is in thinking about all this is the untrended return on cost. And what that is the profit assuming no rent increases. And another really important element of conservatism in underwriting in managing risk of rising construction costs and inflation is you don't trend your rents during construction. Our data suggests that every market we invest in is going to continue to have rent growth over the next 2 years, while we may be building a project from the ground up. But we don't underwrite that. We assume no rent increases during the next 2 years until we can deliver the project. And that's really just an element of conservatism to again hedge against sort of the risk of unknowns as it relates to future costs of building. And so that untrended return on cost is your NOI based on rents today over the cost to build today. And we typically, and Dave touched on this when he talked about the Phoenix margins, we're typically building anywhere between a 5 to 5.5% untrended return on cost. So that's the NOI when the project's stabilized over what it costs to build it. But that project, if it was completely leased today, would trade between a 3.5% and 4% capitalization rate. And so the spread between, let's say, 4 and 5.5%, or 3.5 and 5%, is a 37.5% margin. That margin, again, allows for risk mitigation. You could have costs continue to increase prior to buyout of materials and labor. Interest rates could place upward pressure on cap rates. And affordability constraints could limit rent growth. And you would still be opportunity for profit. A lot of things can go wrong when you have that kind of a profit margin. It's a built-in risk against inflation. So price volatility, understandably stirred inflation concerns, but conservative underwriting, assuming higher cost inputs, but no change in revenue projections, gives you an opportunity to sort of hedge against that risk pretty successfully. Next slide, please. Going back to the idea that if you can control your costs on multifamily projects, that's both the cost to build it, but then also your operating costs, you can create an attractive hedge against inflation through top line growth. Well, a major item to control is the cost of debt. And fixing the interest rate on long-term debt really is the simplest approach to controlling your cost of debt, right? Just fix everything. Rates are still at historically low levels. Everyone anticipates interest rates to go up. The Fed is indicating that they will take steps that will likely lead to increases in what it costs us to borrow debt on our projects. But to benefit from higher margins, much of our portfolio is associated with development opportunities. And therefore, we are employing floating rate debt because you're building as you go along, incurring debt over a period of time. Fixing the debt isn't a better option. You want to float, so you go variable with the amount of debt that you're drawing down over time as you need money to build projects. And much of that debt won't be fixed for 2 to 3 years from today, when projects are built, leased up, and stabilized, and we'll take them to sort of permanent financing. So the opportunity to fix our debt on a lot of projects doesn't really exist today. That would be the simplest thing to do. But to address the possibility of higher interest rates in the future, which we don't know where they'll be in 2 years, we deploy a sort of array of strategies. One thing we can do today is there is an opportunity to secure fixed rate construction financing. And we're exploring, and we have this financing on a couple of investments in our portfolio today, but looking to sort of explore doing more of it is the HUD, the U.S. Department of Housing and Urban Development, has a program that allows you to fix rates, but also draw debt as you go along. So you're not having to fix it on the entire loan balance. You're fixing it as you draw debt to build the project. And that financing lasts for 40 years. So it allows you to mitigate the risk of future higher interest rate exposure relative to when traditional construction loans are refinanced. So there isn't a need to necessarily refinance. You've got that debt in place, and now that debt just becomes your permanent financing long term. There's hair associated with HUD. You know, nothing is a perfect silver bullet to this issue, this problem. It takes typically 12 months, and we're hearing it because of backlogs in HUD's ability to process applications, even 18 months in some of our markets to get through the application process and lock rate. So in the meantime, you're taking interest rate risk exposure and potentially stalling your project and not being able to sort of meet demand before other supply may come. So this is a tool that we're looking at, but it's not the only thing that we're looking at. We also look at a number of different hedging instruments, and we're doing this both at the property and at our fund level. And we can use hedges to help us reduce or limit risk in the long-term interest rate. And these include forward-dated interest rate swaps. And we align those with the expected dates of permanent debt refinancing. And so essentially what a swap is, for those that are not familiar with it, is we find a counterparty who wants to take floating rate risk. And in exchange, we benefit from paying a fixed rate of interest. And then they benefit from taking floating rate risk. They benefit if rates stay low. If rates increase significantly, we benefit because they now take that higher interest rate risk. We can enter into swaps today, but what we're focused on is that forward event when we go from construction financing to permanent financing. And through these swaps, we can effectively fix all or some portion. It's up to sort of us and how we want to structure it in terms of the cost of debt on future permanent financing. So again, if interest rates increase above that swap rate into the future, where we think or where the market is predicting interest rates to be, we will receive payments offsetting that future higher interest costs. If interest rates stay low, there's risk because we would have to pay the higher fixed rate, and the counterparty would benefit from the lower interest rates. But despite that downside exposure, swaps allow for greater certainty of future cash flows and ability to sort of mitigate risk. The other thing we look at is swaptions, which are essentially options to enter into an interest rate swap in the future. Where swaps, you make no payment today. Swaptions, you pay a premium and you have no future risk. If rates stay below that strike price, your option price, you just don't exercise the option. If interest rates increase significantly, you'll exercise the option and enjoy the protection of having a fixed rate at that option price. So I think the way you want to think about this is it's insurance. They can be used to fix a maximum interest rate into the future. That strategy can be expensive. The premiums to do that are quite expensive today, and it could prove to be no benefit. But alternatively, we're deploying this tactic with the mindset of protecting against a significant increase in the future cost of debt beyond current market expectations, which would have a significant impact on margins. So all the work we're doing to buy in the right markets, build the right product, and differentiate that product against competitors in the market to drive revenue growth as a hedge against inflation, well, that can all should be mitigated significantly if interest rates were to run well beyond market expectations. The use of swaptions allows us to buy insurance to protect ourselves against that black swan event, if you will. I think we're at time for questions now, Dave.
Excellent. Thanks, Mark. Nice job. And I just want to add the reason, first of all, if your manager is not hedging interest rates, that's a good sign they're not a risk manager at this point. I mean, we spend 30–40% of our time talking about strategizing on how best to do this in the least expensive way with the most amount of protection. We tend to do it with out-of-the-money swaptions, and swaps are an even better way to do it, but it's complicated. You have to have a lender that has a swap desk, and there's a lot of issues that go into that. HUD takes time. We have HUD loans, and we're trying to do more, but it takes 6 to 12 months to put HUD loan on. So a lot of the times we're talking about doing swaptions as a bridge to HUD, and some of these strategies start to sort of segue into each other. But big picture, we're on it. We think about it, and more importantly, we're doing it. We've done 380 million of swaptions in the last month, just to give you an example of the scale we're talking about, and over 100 million of swaps, and we'll keep doing it. The reason is when you're developing to a huge margin, and we believe that we are, you do want to protect against things you can't control. And so let me be clear. Multifamily investing is an amazing investment in an inflationary environment, but you need to hedge your interest rate risk. And you can either do that by borrowing fixed rate, but when you're building, and that's what we do predominantly, you can't borrow fixed rate from lenders. That's not what's available. So you do variable, and then you either do swaps and swaptions in conjunction with that until you stabilize. I'm going to jump right into questions, and I'm going to take the first one is from, this is actually a live question, Mark, but I think it's a really good one, and I just want to address it. So this is from Bruce. Thank you for your question. His question is, if you and the folks at Origin view inflation as non-transitory, won't this have a negative effect on cap rates? Again, cap rates is your multiple on earnings. As they go down, your multiple goes up. It's a good question, Bruce, but it's much more complicated than that. It's true that the weighted average cost of capital is very important when thinking about cap rates. So another way of saying that is, as the risk-free rate goes up, the first assumption you're making is the borrowing rate goes up at the same rate that the risk-free rate goes up, and that's not typically how it works. Bank spreads tend to come in as the risk-free rate goes up, because the risk-free rate usually goes up in an expanding economy. So your credit spread is going down. But even in a world where your borrowing rate goes up, I'll concede that. If you have enough rent growth, that's the numerator on the equation of a perpetuity, right? So a cap rate is an equation for a perpetuity formula. It's EBITDA 1 plus G, and it's WACC minus G on the denominator, sorry. G being growth. So in our world, growth is rent growth. And so in high rent growth worlds, cap rates don't have to go up as the risk-free rate goes up. And that is exactly what played out last year, by the way. Think about 2021. The risk-free rate essentially went up 70%. It went from sub 1% to 1.55, 16 in December. Now it's at 1.85. But we've already sort of experienced an inflationary year where the risk-free rate went up a lot. And what happened to cap rates? They went lower. Our multiples they expanded. They didn't contract. I'm not presuming that's the case going forward. I don't think that is the case. But I think we could be in a world where they're flat to up a little bit. And Mark, you addressed this in our underwriting, right? We drift our cap rates. Did you address that as well? So, when we don't know where cap rates are going, Bruce. I don't. I could make a case for in a higher interest rate world they should go up. I just explained they don't have to and why. But I can tell you in our underwriting, they always go up. So when we're doing a 5-year model, we're assuming 10% higher cap rates as part of our base case. That's still getting a 50% margin. So there's just so much room to win. And I'm not saying all we'll ever do is win. That's not what I'm saying. What I am saying is we always have a really high expected value. And that's why I'm such a heavy investor in what we do is I've seen this play out for 14 years, and there's just a lot of ways. It's a high expected value, but it's a good question. I'm going to go back, Mark, to the emailed in questions, and you can answer this one. So when do you expect commodity prices to stabilize? And I apologize, no one sent their name, so I can't attach it. Are you putting off construction in the short run in the hopes of stabilization and lower commodity prices?
Yeah, the answer is no. We're not putting off anything for the short term because of inflation. We are scrutinizing deals probably more than we used to for all the things I talked about from our underwriting standpoint. That if a deal can withstand those stress tests, it's a deal worth doing because it'll account for it's accounting for commodity prices where they are essentially today. And if you look at a lot of the forward curves and some of the major inputs to construction, there is an anticipation that pricing will go down. Doesn't mean it's right, and we don't know for certain. And certainly some of the geopolitical disruptions with the war in Ukraine and Western government's response sanctions, it's uncertain sort of what impact that will have on already challenging supply chain conditions. So it's hard to predict when commodity prices will stabilize. But if we're underwriting based on what we can see today, what we can control today, and the deal meets our cost of capital, we've removed that risk from the equation, and therefore we don't have to wait.
That's exactly how I would answer that question, Mark. When margins are as high as they are, you don't wait. There's no reason to wait. So you don't. I'm going to merge two of these. This is an emailed in question. The second is probably capturing the first. How does risk premium for all assets, bonds, stocks, and real estate get affected by inflation, supply chain? I'll answer that, Mark. It's a little bit similar to my last answer. So the reason that bonds have been such a bad investment for the last year, they've been extraordinarily bad. I mean, people have invested in an asset they just wanted cash flow and low risk, and instead they got negative returns out of it. Now, the way it works with bonds is if you buy a bond with a 1% yield and it goes to 2%, you're taking a huge loss if you sell the bond. That's a 10-year note. So if you sell it after year 2, you're going to take a huge capital hit. Or you can hold on to it, but you're getting a 1% return and you should be getting a 2%, right? So it's just net present value of your lower yield. And the whole time you're getting a negative real return because let's just say inflation is 7%. That's just about where it is now. But let's say it averages 4% for the 10-year period. You're getting, if you're at 1, you're getting a negative 3% return for 10 years. So it's very destructive. Now, why do stocks and real estate behave differently? Because they do. It's, again, because it has that growth element. A bond doesn't have any growth element. It's a fixed income stream that you've signed up for. A stock, you don't know, and real estate, you don't know the capital appreciation or the rent appreciation. Certainly in multifamily, because it resets annually. You know, if we had a 10-year lease in multifamily, then I would say, no, we don't have this ability to grow, but we do because it resets every year. And right now it's resetting at, 10, 15% higher. And so that's obviously a lot of growth. So it's very unclear with growth assets what happens in an inflationary environment. With bonds, it's actually quite clear. It's bad. And you're going to see capital depreciation, or you're going to get stuck with a yield that's well below the real return, right? So it's not a good situation for investors. What's interesting is the typical portfolio right now is stocks and bonds, and it's not working. So in January and February, stocks have gone down in value anywhere from an index standpoint, 5 to 10%. But if you're in some of these high growth stocks, much more. Typically, your bond portfolio should be offsetting that with positive returns, but it's not. So you're actually getting negative returns in both sides of your portfolio. Real estate is actually the part that isn't correlating, meaning it's holding its value. And that should make sense. Mark, one last thing we should touch on, because I don't think we said it directly. In an inflationary world, the cost to replace an asset keeps going up. So we keep talking about construction prices going up, and that's true. That also means that all of the buildings that we own are also going up in value because to replace them is going up.
Yeah.
So to build a building this year costs 15 to 20% more than last year. And that's frustrating, sure, but I'm telling you, the margins to build are still there. But what also is happening is all of your existing buildings, you see this in the residential side too. Why do you think the residential market keeps going up in value? Part of it is replacement costs. You can't build at the same prices as built homes. And that's another reason that, hard assets, real estate in this case, are such a good asset to own in an inflationary environment. Next question. Mark, what does a capital stack, debt and equity, look like at origin typically?
Yeah, so we typically will put 65% loan to cost. So 65% of the total cost to develop a project will be through a construction financing. When we put permanent financing, that may go to 70, but we'll never go above 75% on anything that's a sort of common equity investment. And that's staying true to another tenet of risk management, that although you could significantly enhance your returns by putting higher levels of debt than what we put on, you're taking a lot more risk. And when you're in first loss position, if anything goes wrong, your equity is the first to lose. So the less equity you put in, the greater the chance there is for any disruption in the cash flow of a particular project to impact you adversely. So putting reasonable debt, not overly aggressive debt terms on these projects is another tenet of sort of managing risk, in addition to all the other things that we talked about.
We have a live question from Adrian. Thanks for your question. He is posing the scenario where inflation is really 2 to 2.5% long term. Maybe it transitions to 3 to 4 in the short term. Adrian, that's totally reasonable. Could be correct. He asks about the assumptions in rent growth. I think his presumption is if inflation is lower, then rent growth should also be lower. And how do we think about that? So how we think about this, Adrian, Marc covered this a little bit. In all of our developments, we don't trend rent at all. So think about last year, if we started a development, we had a 0 in rent growth for the year in our model, but rent growth was 10 to 15%. So we're way ahead of the game. Once we start putting rent growth in a model, and depending on the type of construction, that could be in year 2, 3, as it stabilizes and it's built and starts to get rented. We rarely exceed 3%. And we have AI models, machine learning tools that we use here. But even when it's showing 7 or 8%, we won't use higher than 3.5%, 4%. We just won't do it. And certainly won't keep it at that level, because when you do that, you run into affordability issues. You can't grow things at a high rent growth rate. It starts to exponentiate, and you run into affordability issues. You really don't want affordability ratios beyond 30% in multifamily. Like, in other words, 30% of your renter's income is going into that asset to pay for it. So these are all things to think about. We use reasonable rent growth, even when it's much higher. We don't trend during construction. We're in the weeds a little bit, but it matters. When you're looking at a manager or an individual deal, you need to ask these questions. You need to ask how they're hedging their interest rate risk, and get in the weeds. Make them explain, make them convey to you that they have a real strategy, right? You need to ask about rent growth. You need to ask about how they treat cap rates in their models. It's important. And if you don't know enough to ask the questions, you need to focus on manager selection. Who's the best manager for me to partner with? Or you need to hire a consultant, someone that does. You've worked too hard to earn your money, to not spend time investing it properly. Next question. We have 2 minutes left, Mark. And in this case, I'm the one with a hard stop. Okay, this is a great question. It's anonymous, but I think it's interesting. So as states like California, this is a hypothetical. What if they started changing their policies to stem outflows of residences? How would this affect your model at origin? Because obviously we're benefiting from that demographic trend.
Yeah.
How would you answer that?
Yeah, we look at baseline population growth. The markets that we're investing in, there are reasons why people are moving there other than trying to get out of places where the policy making is chasing them out, or affordability is forcing them into other locales. So as I mentioned in our proprietary AI model, there's a large number of inputs that go into sort of identifying where are the places where people are going to want to live, where are places where companies are going to locate and create jobs that will also either responding to the fact that people want to move and live there, or are going or are creating the reason for people to move in those locations. So a lot of those fundamentals aren't dependent on growth from California or people moving from higher price cities or dense cities like New York or Chicago during COVID. That certainly has benefited a lot of the markets that we've invested in, people moving from those sort of higher cost cities to places in the Sun Belt, in Texas, in the Southeast. But those places have had a long-term trend of attracting population growth long before COVID. And those reasons there still will persist, the reasons why people are moving there. And those cities have become a lot of the cultural elements that people appreciate about cities like Chicago, Boston, New York, San Francisco, LA. They're in places like Atlanta and Dallas and Tampa and Jacksonville. Those aren't devoid of those lifestyle amenities, if you will. And we see growth not being significantly disrupted if states like California change their policies and we're able to address the affordability question and taxation concerns that are driving people out of those states.
Yeah, I think there's a presumption there that they have these options. Like I'm in Chicago, big fan of Chicago. I've lived here a long time. We have structural problems. We have hundreds, I think 140 billion of pension liabilities that we can't pay. And so this notion that we could somehow cut taxes and change the paradigm, we can't. Like if anything, we're going to have to increase taxes unless we can figure out another way out of it. So there's a presumption that these states have flexibility. New Jersey's in the same position we are, New York. California has, if you're a high earner, 10, 11, 12, 13% state income tax. It's going to be very difficult to go from that type of revenue model to zero. That's what Florida is. That's what Nashville is. That's what Texas is. So it's a great hypothetical, but I don't think it really can happen in a practical way, unfortunately. I wish I had a better answer, but I don't. I'm sitting in Illinois. So I'm going to answer the last question. There's two forms of this question. So thank you for your question, Thomas. It's about construction timeline and then lease up. So people are asking about how do we hedge and get ahead of delayed construction times because of the supply chain disruptions. Interesting enough, we haven't seen this as much. So it's a risk, but we've been able to manage through this side of it. And you do it by being experienced in development and understanding construction sequencing. And so, it's important to understand that it's not just inputs. It's also things like appliances. You have to get well ahead of those orders months and months and months before. and sometimes have places to store these in the interim, because just in time doesn't work anymore in this global economy. So we've been able to manage that very well. It's not an issue, it is a risk, but it hasn't shown up yet. The second question Thomas asked was about lease-up timeframes. This hasn't been an issue at all. So we typically are underwriting anywhere from 10 to 13 leases a month on our deals. And we've been able to come in at the high end of that, or in some cases, way above it. Like, for example, a Fund 3 deal in Houston, Haven to Bel Air, we were averaging 25, 30 leases a month. So in an environment, remember what I talked about 35 minutes ago, 700,000 absorption last year against 360,000 new supply. It's not going to be difficult to lease up. And that's kind of the big point we're making about cap rates, about valuations. The fundamentals are so strong that it's very difficult. It shows up in the margin too. But the lease ups are very quick because there's just a lot of demand for this product, for rental product. And in particular, we're building higher end rentals for sort of the renter by choice segment. Marc, thank you so much for your time. I know how busy you are, especially I believe we have 5,000 units in development. So I appreciate you taking some time out.
Yeah, no, thank you, Dave. Great conversation.
And thank you for joining us, everyone. Great questions. I hope we addressed some of them. If you do have more questions that we didn't have a chance to answer or you didn't ask, you can email me directly, david@origininvestments.com. All of my information is on the website. I will either answer it myself or I'll forward it to Marc or any one of our 40 team members that would be happy to answer it. Everything you want to know about Origin is on our website. We have 4 funds that are currently open for investment, really across the risk spectrum, anything from a very low risk, 8 to 10% return to today we're focusing more on development, which is our highest expected value. That's Growth Fund 4 or QOZ Fund 2. So if you have interest in any of these things, contact us. It's all readily available on the website. Thank you for your time. Have a great day.